Guys, welcome back to an edition of the blind stock analysis. What we do here is we pick a stock. Now, in this situation, we had the people in our community, our everythingmoney.com community. There's thousands of people in there. Tim yesterday put a poll in there and said, guys, we want to do a blind stock analysis video. Somebody select the stock, see who gets upvoted. So what this is we see the metrics, we see everything, and we try to guess what company it is, okay? Now, behind me is the first page of our software. So Tim, our producer / CEO, came here, took the screen, took out a couple of things in here, but let's first look at this. Revenue of $10 billion, net income of 1.56. Now look at this, Mo. Very consistent profit.
Yeah, that's what I was looking at.
And a pretty healthy gross margin.
Good margin. Yep, good gross margin.
Pays a dividend. Okay, the dividend eats from about half.
A lot, but I'd
actually.
Well, maybe there's some kind of anomaly discrepancy in the income statement.
A lot of debt. Oh no, we don't know the market cap. Oh no, we do know the market cap.
Yeah, well, we guess we do.
The market cap's about 43 billion, and the total enterprise value is 51. So about $8 billion in net debt. Okay, high return on invested capital. Wow, 19.5. So is this software? No, it seems a little low on the gross margin for software.
Yep. Go to the income statement.
Okay, let's go to the next page. Okay, very flat revenue. Look at this. Very, very flat revenue. A little bit of surge last year. Profit. They did a good job, even with revenue being flat, getting the profit up. You see that, Mo?
Yeah.
Revenue's up about 20%. Profit's almost doubled.
Yep. Okay.
Which makes sense with a 42% gross margin.
Okay, where are you going next?
Shares outstanding. They're buying back shares. Ooh. Wait, what happened here? Do you see this, Mo? Shares outstanding. Okay, let's ignore that right now. All right. Total current assets, $2.69 billion. This is the balance sheet. Total current liabilities, $3.39. So they're upside down in terms of working capital.
Don't like that.
That's definitely not. So is this a food business? Because the food business tends to have current assets less than current liabilities.
But if it was food business,
10
margins would be lower.
Not necessarily. What's Darden? What do you think their margin is? They own Olive Garden. I mean, it seems like it could be a $40-50 billion company.
I would think it would be more, but maybe you're right. Let's go.
You think it'd be more?
I thought it would be like 80 billion.
No.
I thought it would be double.
I'm saying it's Darden already.
All right.
Total liabilities, 7.75. Total assets.
So let's look at the 8 pillars real quick.
Well, let's look at what is going on here?
Actually, I want to go to the cash flow statement, see if there was any acquisitions.
Yeah.
Because that
acquisitions every year.
Those shares doubled.
So I don't think that's
Darden.
I don't think that's Darden then. Because what would they be acquiring? Oh, they might be acquiring different brands, but it's low capital expenditure, which makes sense. If restaurants, you do the build out, it would be 20-25%. That's what they're at. 30% going down. Free cash flow average, 1.5 billion, which is pretty consistent with their profit. Okay. Here's their 8 pillars. Huh
is right.
Is it retail, Mo? But there's not a lot of debt. And you saw the long-term capital lease obligations. The one thing that was confusing me, Mo, is this. Look at their long-term capital lease obligations. It plummeted. 4.4 billion, 417 million, 3.64, 406. So maybe there's something wrong in the reporting of how Morningstar is sending us the data, because this is way too inconsistent. But total long-term liabilities, I think there's just an error in the data how they're sending us these numbers, because the long-term liabilities are decreasing, but not by much. Man, is this retail? What would be a retail location with 43% margin? $45 billion market cap, $10 billion. Dollar Tree, is that too much?
I think it's too much.
No, too little. Is it too much?
Dollar General is probably more in market cap.
Okay, let's go back to, is there more? EPS growth. Mid, high single digits.
Did we get a chart here?
Revenue growth, yeah, at the very beginning.
Well, that's not very helpful.
Yeah, and the drop for COVID wasn't as big as I would have thought.
That's what I mean. It's not that helpful.
Revenue growth.
So I think it's retail, and I'm basing it off of that, not a big drop during COVID.
We'll see, but retail and restaurants dropped a lot.
Some did.
Who didn't?
Companies like Amazon.
Yeah, this is not
I
Amazon.
know it's not Amazon, but companies that had a really good online presence at the moment.
Okay, so our community,
it's
people
not
who are
Best
watching,
Buy.
this is a good one. Because I'm pretty
This is a
sure,
really good one.
but man, even for retail, it seems, well, unless it's a specialty store, that ratio 4 to 1, 4.3 to 1 in terms of price to sales, man, high ROIC.
Very high. Trying to think of companies that I've gotten where I've seen the 8 pillars just like this, where a lot of it makes sense, except for the debt.
Yeah, that's the problem with the debt. Huh.
Well, we gotta narrow it down to a sector at least.
Yeah. Do we think it's retail? It's not the car business, is it?
Nah, I don't think so.
Oh, that's definitely not, because the 40% gross
Exactly.
margin, there's no way that's happening.
Exactly.
It's not like CarMax, or maybe it's Carvana. Just kidding.
No, the chart would be basically.
So
zero.
I think it's restaurant or retail.
Which one are you leaning more at? You're leaning more restaurant.
I think I know the share price too, working backwards.
You know the share price?
So, by the way, the fun part about the blind stock analysis is it's not possible for Tim really to give us the information we need that we wouldn't be able to somewhat circumvent it. Because look, if the EPS is $8 and the 5-year PE is roughly 30, the stock is somewhere, let's say EPS this year is, in the last 5 years, is average 7. So it's in the 200 to 300 range right now. That's what the stock price is.
I don't think that's Darden.
Is that correct? Okay,
I
that's
don't think that's Darden.
that's not Darden.
I
Well,
don't-
Darden
I
was.
don't think so. Because remember when we were looking at them, they were like $80-$90.
Let's do stock
Sure, let's do
analyzer. So what
stock
we're going to do here is Tim's going to have me not look, and we're going to do stock analyzer tool. Okay. I would say revenue growth. Mo, what are you thinking?
You think 2, 4, and 6 is too high? 1, 3, and 5? I think 1 might be too low.
Oh, I bet I know the company.
Say it.
Sherwin-Williams.
Aren't
Fudge.
they like 600 a share?
No, they're down to like 220, 230.
Okay. What do you think about what I just said?
What'd you say?
1, 3, and 5, or 2, 4, and 6? I feel like 1 might be a little bit low.
Yeah,
6 might be a little bit
246.
high.
246. Okay, profit margin, 13.5, 14.5, 15.5.
Sure.
And do the same thing for free cash flow margin.
14, 16, 18 on PE.
Once Slowpotamus over here is done. Jesus Christ. 14,
14, 16, 18.
I don't even know if 18, but do it.
I think 18 might be high.
Do the same thing.
Return.
12. I didn't see.
I
Did
didn't
you
see
see?
either. No, I didn't see.
12, 13.5, 15.
All right.
Okay, let's turn around in case.
Yeah, in case
Tim-
something pops up on the bottom or Tim scrolls too fast.
Okay, so low price of 78, a high price of 110, mid price 93. Now, for those of you who are new to the channel, the goal of all this is that we want to be able to look at companies without the bias of knowing about the company. We
Right,
want to
right.
look at it for the numbers and say, what would we pay for a cash flowing business like this? Now, is that really realistic? No, but I do suggest this. That way you can be unbiased. And then after you see the price, say, okay, I'm going to adjust this up because I like the company and the industry. So
If it was on my watch list,
what are you thinking right now? Like, what company is it?
I don't know. I'm at a loss. Usually I have a pretty good idea.
Oh,
Never would have got that.
oh,
Never would have got that.
Hershey Company. Hershey Company. Okay.
Wow.
I'm actually surprised how good it looked. Guys, and guess what?
I am too.
Hershey's, that thing ain't going
It's
away.
not going anywhere. That's exactly
So
right.
are you willing to pay a premium for Hershey's? I'm surprised about the total current assets versus
Me
current
too.
liabilities.
Me too.
Is it on my watch? It's not even on my watch list, is it? So let's add it to my watch
I'd
list.
probably put it in there somewhere around $85. Don't you think?
Oh, see, I disagree.
Something just got disconnected.
Yeah,
Might be over here.
the thing got disconnected.
What are you going to put it in at?
I don't know. Let me see.
100?
No, I might put it at 120 and start from there. Now, this doesn't mean, guys, that I'm buying it at 120. What it means is I'm adding it to my watch list. When it hits 120, I'm going to reevaluate. And if I still like it at 90 or 95, I'll start selling puts at some point. I just want to keep it in my reminder. That's why the watch list is so great. Sorry, I'm going to get a message on my app. I'm going to get a message on the website. I'm going to get a message over email telling me Hershey went below your price target of 120. So guys, if you like this, subscribe to the channel. There's a ton of videos. We do 2 or 3 a day. We're awesome. We're the best. Thank you very much for your time. There are 3 things that you absolutely need in order to be a successful investor: the proper mindset, the proper emotion, and the proper process. Which ones are the most important?